Hello, it's Ed Butowsky. I'm honored and pleased to have a partner of mine, Ray Micaletti, on today. He is our Chief Investment Officer with Ethos, who is a partner of ours. Ray, thanks for joining us today.
My pleasure, Ed. Happy to be here.
Let's turn our attention to interest rates,
Okay.
because usually interest rates drop to stimulate the GDP of a country, because the country is weak. And our jobs numbers have come out recently being very anemic. But there's a 25 basis point drop just announced. I do believe we're going to see a 50 basis point drop in October. And that's just my personal feeling, because I think our GDP number is going to be very, very weak.
Okay.
What do you believe interest rates are going to do?
So I do think that the Fed will continue to cut rates at the short end. Powell was just giving a speech, and I was reading some of the tweets about it before we got on this podcast, and he was essentially really down talking the jobs market, saying it's very weak. So that was essentially his way of saying, yes, we'll continue to cut rates. So at the short end, I do think rates will continue to fall. Now, whether that will lead to interest rates falling on the long end or not, I think is an open question. If the economy is slowing and we also see inflation starting to slow again, then yes, I think that rates on the long end will come down. However, inflation has been kind of ticking up lately, and if you look at a year-over-year basis in August, which is our latest CPI number came from August, on a year-over-year basis, on a 1 month, 3 month, and 6 month annualized basis, inflation in October was greater than in August was greater than inflation of August of 2024. So inflation is starting to creep higher, and by cutting rates at the short end into already easy financial conditions, that might cause inflation to pick up even more. So the long end of the curve might say, well, we're a little bit worried about inflation picking up here. If growth remains solid, you think it might not remain solid, but if it happens to, and they're cutting rates because of the weak job market, then we might see more inflation, which could lead to the long end going higher. Another thing to be concerned about, I think, is that whenever they issue new debt and we have this huge deficit, right, they're kind of trying to concentrate it on the short end, because the more supply you put at the long end, that will drive rates higher, bonds lower, and that will hurt, mortgage rates and things like that, things that run the economy. However, for example, if we have a recession or if equities fall, that will, higher unemployment means lower income taxes. A lower equity market means fewer capital gains receipts. So the money that the government collects in taxes will go down, but their spending won't go down. So the deficit will increase. Supply of bonds will increase. That could put pressure on bonds to go lower, which would then raise interest rates. So I'm not sure what's going to happen on the long end. If inflation kind of is calm, we could see rates go lower, but if it isn't, or we have a recession, I think that you could see interest rates go higher on the long end.
So I'm going to put you on the spot.
Okay.
This is my last question. If I gave you $1 million today, how would you allocate it?
What is the time frame?
10 years.
10 years. Okay. If it's 10 years, then I would definitely have energy stocks. I would definitely have silver and gold and broad commodities. I would have emerging market equities. I would have other non-U.S. equities, say developed markets, which have underperformed U.S. equities for 15 plus years. I think they will outperform. If I had to have U.S. equities, I would probably have small caps over mega cap tech companies, simply because they've underperformed for so long. So I would probably take all of those 5, 6, 7 things I mentioned and essentially equal weight them, because if you equal weight gold and silver and commodities and energy stocks, we have a very big concentration in real assets, and then on the equity side, probably 1/3 to emerging, 1/3 to developed, 1/3 to U.S. small caps. I would also have some Bitcoin as well. I think Bitcoin, if it doesn't go to zero, I think it will be the beneficiary of a dollar that's probably destined to weaken a lot more.
Okay. Ray, you're wonderful. Thank you very much for doing this.
My pleasure, Ed. Anytime.
Thank you.